Welcome to another episode of Millennial Investing Explained. Here's today's question. You've developed a popular framework of principles that someone can use to manage their behavior when investing. Can you share with us those principles and how someone can manage their emotions more successfully when investing?
There's these 4 biases that I've coined. So I looked at the research into investor bias and found that there were over 177 different cognitive errors that we fall prey to, which is, crazy. How do you account for, not doing 200 things wrong? And so what I did was I drilled down into these nearly 200 things and said, okay, what are the sort of psychological tendencies that underlie these 200 things? Because they're not all that different. And so the thing that I walked away with was 4 things. The first was ego, which is this tendency of ours to be overconfident. The second is emotion, which is our tendency to let our heart run away with our head. The third was conservatism, which is our tendency to be sort of lazy and prone to the status quo and being risk averse. And the final one was attention, which is the tendency for us to evaluate the likelihood of something not on how probabilistic it is, mathematically speaking, but how salient it is psychologically. Many more people die every year taking selfies than are eaten by sharks. And yet, we're scared of sharks and we're not scared of taking selfies because the shark attack is, the shark attack is much more salient. We can imagine it. We can envision a shark attack more catastrophically and more vividly than we can envision, drunkenly stumbling into the road while taking a selfie. Those are sort of the 4 major investor biases that I identified in my books. And, I feel like if we can develop frameworks for keeping those things in check, you're sort of on your way.
That's all for this episode of Millennial Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.